and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth, and I am delighted today to be joined by Richard Champion, our Co-Chief Investment Officer. And Happy New Year, everybody. This is the first Canaccord Coffee Break podcast of 2026. So hopefully we're looking ahead to a very happy and prosperous new year. And as you will know, this is based on our weekly markets review, which we send out every Monday to subscribers. And the podcast is here really to be a bit more bite-sized, but demystify what's going on in hopefully a simple and easy to understand manner, and give you a greater confidence to invest in your financial future. So Richard is here to help me do that demystifying.
Thank you.
Nice to have you here. And don't forget, if you like what you're hearing, don't forget to follow us on Spotify or Apple or your other podcast channel of choice, and so you never miss an episode. So let's get into it. Grab your coffee, plug your ears in, and here we go for about the next 10 minutes. So Richard, to start off, I thought it might be quite good, being the first podcast of the year, to have a quick look ahead at what you expect, hope to happen in the year ahead, and how this might have an impact on our clients and on how people are investing.
Thanks, Jane, and Happy New Year to all our clients who are listening. Thank you very much for supporting us. Yes, 2026, a new year. After two really good years for markets, in particular for equity markets, and there are some natural questions that arise from that.
Yeah.
But our core view is that as we set off on this year, the situation is reasonably good. Perhaps not quite as dramatically good as we've had in the last 2 years, but reasonably good, with both equities and bonds yet again helping to drive portfolios forward. In the last couple of years, it's been equities which have really dominated, with bonds being a little bit more pedestrian. This year, perhaps they'll both be more similar in terms of their results once we reach the end. And the key point is to yet again to stress that we expect it to be a volatile environment, despite by the end of the year, a reasonably good outcome for our clients.
So what is driving that volatility then?
It is the uncertainty that we see. We've already had geopolitics rearing its head.
We have.
In terms of what's gone on in Venezuela, what's happening right now on the streets of Iran, in both tragic and heroic circumstances. And indeed, what we might discuss in a minute, which is what's going on with the US Federal Reserve in the US. So it's that geopolitical environment that's part of the volatility. And the other is that after two really good years, equity valuations, although not horribly extended, have gone up a lot worldwide. And that, of course, adds some uncertainty.
Okay, so should we get into those 2 points then?
Why not?
So first off, let's talk a little bit more about what's going on with the US. And I know the Department of Justice have taken aim at the Fed, or at its chief anyway, Jerome Powell, and have served grand jury subpoenas. Powell has fired back, saying this is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation. So there's quite a lot going on there. Can you just unpick some of that for us, and therefore why that leads into the volatility that you were talking about?
Yes, I mean, markets over the last 30 or so years have become very accustomed to independent central banks, which are not prey to political pressure. And that's the same whether you're in the US, in Europe, or indeed in the UK. And there's been a sort of a general consensus that central bankers quite often get it wrong, but they get it wrong for decent reasons, whereas politicians might get it wrong for bad reasons. And the fear with what's happened is that President Trump has made it absolutely clear that he wants much lower interest rates, very much lower interest rates. And the fear is that by imposing his will on the Fed, he will get his way at a time when the US economy, in our view, is doing all right and probably needs a little bit more monetary easing, so a little bit more lower interest rates, but doesn't need to be too aggressive.
The economy's doing fairly well.
In the US, it's doing pretty well. And the fear always from politicians getting involved is that they are looking at a political cycle. And of course, that's what we're seeing in the US. We've got the midterms coming up. So markets are concerned that what we'll get is an unleashing of stronger growth and possibly more inflation. And we all know that we don't want...
Because of interest rates being
too low. Exactly.
Okay.
Yeah.
So I also saw that gold had moved higher, presumably off the back of the same macro environment. So what's happening there with gold?
So gold has been already a superb asset over the last 2 years, up well over 100% in dollars and about 100% in sterling over the last 2 years. And it's now reached the point where gold has never been as expensive in its entire existence, by which I mean over several thousand years. So why is it still going up? The simple reason is we've never had a situation when the central governments have been borrowing so much in peacetime and when the economy is doing quite well. And people are worried that the governments are going to debase on their debts, which means they're seeking out the safe havens like gold.
So debase on their debts. Just talk us through that.
Yeah, US debt to GDP, i.e. the amount of government debt it has relative to the size of its economy, is about 120%.
Right.
And growing very fast. Normally, lots of studies have shown that if you go much above 80%, some people say 90, but 80%, that has a long-term depressing effect on economic growth and makes it very difficult to get out of the cycle. And of course, the US is well above that now. So people worry that effectively they're going to use inflation to get rid of that debt.
To get rid of the debt, because they can't afford to pay it off any other way.
Correct.
Just sort of float themselves away from it, sort of thing.
That's exactly right.
Okay. I think I understand. Okay, so why are people then investing in gold when it's at such a high level?
Because there are few other assets which give you that protection
against the debasement of a currency.
Debasement. Okay. We've never been in a position where we've had such high government debt and economies have been so divorced from physical assets, because obviously the central banks can turn on the printing presses and do what's being called QE, quantitative easing, and that also has an inflationary impact.
Okay, so let's just loop back to corporate earnings we touched on. I guess this is also driving equities higher. So what's the outlook for strong corporate earnings over the next period?
Let's just look at the US, which is about 2/3 of the world equity market.
Yeah.
There, people are expecting about 15% earnings growth in 2026. We've just had JP Morgan, the world's largest bank, issue numbers, and they were good.
Yeah.
Share price a little bit down, but it's been super strong beforehand. And that's encouraging because with highly valued equities, a healthy market has strong earnings to back that up. And we're seeing that at the moment. So one of the key questions in 2026 is, do we see that momentum carrying forward?
And do we?
At the moment, we do.
Key question.
At the moment, we do. So we've got interest rates coming down, a decent economy. We've got a secular driver in terms of AI investment, all of which is helping corporate earnings. And we're very, very sensitive to making sure we're monitoring inflation, for example, and we're monitoring some of the influences on it that may make markets more skittish.
So there is a fear about a downturn in the current high valuations. Are high valuations a predictor of a downturn?
Not in the short term. So a lot of work's being done by a number of academics, which shows that on a 1 to 3 year view, high valuations have no correlation with the returns you get from the market. But on a 10-year view, they do have a very strong correlation.
Okay.
So based on that, that's people are worrying about whether we can continue with the super strong growth that we've seen over the last couple of years.
Okay, got it. So let me just sum up then what's in my Canaccord takeaway coffee cup today. So I think we're sort of starting this year as we ended last year. There's a US administration and Fed spat going on. That continues to add some uncertainty around that political pressure on the independence of the Fed. But the UK and US stock markets have both reached record highs in the last week or so because corporate earnings are seen to be strong given the backdrop around interest rates and inflation. So we feel 2026 likely to see corporate earnings and progress, that's a good word, progress, but also likely to be nuanced, uneven, volatile. So strap in for a bit of a ride on that front. And we hope that we can keep an eye on what's going on in the macro space in order to support client valuations going forward.
Correct. With an eye to inflation, still think we'll get good returns, but just being a little bit more conservative with what we think our returns might be compared with the great returns we've had in 24 and 25.
Yeah, fair. Okay, well, thank you very much for your time, Richard.
Pleasure.
And thank you for listening to the Canaccord Coffee Break podcast. I hope you enjoyed it today. If you have any feedback for us, anything you specifically want to hear more about, do please share your thoughts with us at coffeebreak@canaccord.com. Thank you.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.